Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through all the market weakness and noise. I'm your lead analyst, and with me, as always, is our market skeptic. Now, today we are digging into a classic Wall Street puzzle, a real head-scratcher. How on earth can a company report what looks like a rock-solid quarter, beating expectations left and right, and then watch its stock get absolutely hammered? It makes no sense on the surface, but it's exactly what happened with Signet Jewelers. You know them. They're the parent company of Kay, Zales, and Jared. So when you look at their report, everything looks polished, brilliant even. But the way the market reacted, well, it suggests there are some serious flaws hiding just beneath that shiny surface. Our job today is to put this company under the loop, inspect it from every angle, and figure out if this is a true diamond in the rough or just a very convincing piece of fool's gold. All right, let's get into it. Okay, so to really understand this paradox, you have to start with the foundation. You have to look at what the company actually reported. And when we dig into Signet's fourth quarter and full year results, honestly, it looks like they've built a fortress. The headline numbers were undeniably strong. They suggest a company with real structural integrity, a solid performance record. This is the story that management wanted to tell Wall Street. And you know what? Based on these initial numbers, it's a really compelling one. So let's walk through the exact figures that should have sent the stock rocketing higher before we uncover why they did the exact opposite. So let's start with the bedrock of any earnings report, earnings per share, or EPS. And what we're looking at here is a huge number. Signet posted $6.25 per share for their fourth quarter. Now, for anyone who's new to this, just think of EPS as the ultimate bottom line. It's the pure profit a company makes for every single share of its stock that's out there. In today's market, which has been really tough for retailers, a number this big, it's like a massive pillar of strength. It signals that the company is not just selling a lot, but it's running its business efficiently and, most importantly, profitably. This is a fantastic starting point. But, of course, a number like that doesn't mean anything in a vacuum. It's all about context, and that's where this next number comes in. Wall Street's army of analysts, the so-called experts, they had crunched their numbers and built their models, and the consensus was that Signet would earn $5.93 per share. So let's be crystal clear, Signet didn't just meet expectations, they blew them out of the water. They beat the street by 32 cents. That is not a little rounding error, that is a significant, powerful outperformance. In any normal market, a beat of this size is a massive bullish signal. It tells the entire investment world that the company's internal engine is running hotter and better than even the most optimistic outsider believed. This alone should have been the catalyst for a major stock rally. And believe it or not, the good news didn't stop with the profits. Let's move up to the top line, revenue, the money coming in the door. As you can see on this table, the story of outperformance just keeps going. For that crucial fourth quarter, they pulled in $2.35 billion in sales. And again, they just edged out the Wall Street consensus of $2.34 billion. It might not look like a huge beat, but beating on both earnings and revenue, that is the Wall Street equivalent of a grand slam. It's exactly what you want to see. But zoom out and look at the full year numbers. Total sales for the year hit $6.81 billion. And I want you to pay very close attention to this last number here. Same-store sales, or SSS, was up 1.3% for the entire year. Now, this metric is absolutely critical because it strips out any growth that comes from just opening new stores. It tells you, for the stores that were already open, are they bringing in more money than they did last year? Getting a positive number here, even a modest one, shows that the core business itself is healthy and growing organically. From top to bottom, this report looks like a financial fortress. Okay, hang on, lead analyst, because this is exactly where my alarm bells start going off. The CEO comes out with this perfectly polished textbook quote, heightened focus, comp growth. It sounds fantastic, but is this anything more than a pre-written victory lap? Is there anything real and tangible behind these words? The numbers on the page look great, sure, but we have all seen companies polish the chrome to a mirror shine while the underlying frame is rusting out. I'm just not sure the market is going to buy this corporate speak. And that's the perfect setup. So we've established the foundation, right? They beat on earnings. They beat on revenue. They showed positive same-store sales growth for the year. By all normal metrics, this company should be taking a victory lap and its stock should be soaring. But this is where the story takes a very sharp, very puzzling turn. Because despite this seemingly flawless performance, the market reacted with extreme prejudice. So this brings us to the absolute core mystery of Signet's report. We have to start looking for the cracks in the armor. We have to find the hidden stress fractures that cause smart money investors to stampede for the exits instead of rushing to buy more. And just before we reveal the fatal flaw in this story, let's put the final capstone on this tower of good news, just to make the puzzle even more confusing. The company's board of directors announced they were increasing the dividend by nearly 10%. That bumps the quarterly payout to 35 cents per share. Now, this is absolutely crucial. A dividend increase is one of the most powerful signals a board can send to the market. It's them saying loud and clear, we are so confident in our future ability to generate cash that we are formally committing to giving more of it back to you, our shareholders. And this wasn't just a one-time thing, it shows a pattern. This was the 5th consecutive year they've raised the dividend. This is the hallmark of a healthy, mature, and shareholder-friendly company. All right, I have to jump in right here because this is the question that everybody watching is screaming at their screen right now. You have laid out an absolutely ironclad case for the stock to rally. They beat earnings, they beat revenue, they grew the core business, and to top it all off, they raised the dividend for the 5th straight year. I mean, these are literally all the ingredients you would look for to see a massive surge in the stock price. So the billion-dollar question is this: what on God's green earth did the markets see that we're all missing right now? If the financial house is this solid, why did it start to crumble the second this report hit the wire? Something else has to be going on. And that right there is the question that defines this whole story. This slide lays out the market's final verdict in cold, hard numbers. On the very day that the stock should have been celebrating this incredible performance, it fell 2.25%. Now, this wasn't just a little dip or some profit taking. It was a clear, unambiguous rejection of the company's narrative. The market looked at that strong foundation, it saw the polished exterior, it heard the good news, and it decided it did not trust the blueprint for the future. And to understand why, we have to stop looking in the rearview mirror at their past performance and start looking through the windshield at what the company itself sees coming down the road. This is it. This is where the rubber meets the road. The stock market is a forward-looking machine. It doesn't really care about what you did last quarter. It cares infinitely more about what you're going to do next quarter and next year. And the one place a company reveals its own unfiltered view of the future is in its guidance. This is management's official forecast. And it's right here, in the guidance, that we finally find the major structural weakness in Signet's story. The numbers they projected for the upcoming fiscal year revealed the incredibly heavy lift they have in front of them, and frankly, it was a heavier lift than the market was willing to underwrite. All right, everyone, this slide right here is the smoking gun. This is the entire reason we're having this conversation. On the left, you have Signet's own forecast for the next fiscal year. They are telling the world they expect to earn somewhere between $8.80 and $10.74 per share. Now, let's just take the middle of that range, the midpoint, which comes out to $9.77. Now look over at the right side of the slide. That number, $10.59, is what Wall Street analysts were already expecting. So Signet is basically telling the market, hey guys, our best case scenario for next year is significantly lower than what you're all hoping for. And it's the exact same story with revenue. Their forecast midpoint is $6.75 billion, while the street was looking for $6.9 billion. This is a direct, unambiguous signal from management that they see a slowdown coming. They are tapping the brakes, and the market slammed the eject button. And the company isn't even trying to hide this weakness. They are openly blaming a $60 to $80 million headwind on this big transition of their James Allen brand, which they're basically shutting down and folding into their other online brand, Blue Nile. So my question is this a brilliant strategic move to streamline their online business for the long term? Or is it just a really convenient scapegoat for a much bigger, more fundamental problem with their business? That is a huge chunk of revenue to just write off as a transition cost. It really makes you wonder what's actually going on with their online sales engine. Okay, so management isn't just sitting there blind to these challenges. They know they have a problem, and they know they have to pivot. In response to this weak outlook and the clear shifts in the market, they've rolled out a brand new corporate strategy. This is their official blueprint. It's their plan for reinforcing the foundation of the company and preparing it for what they hope will be sustainable, long-term growth. This is their answer to the very weaknesses that their own guidance just exposed. So let's drill down and see what this new plan actually involves. The official name they've given their new blueprint is the Grow Brand Love Strategy. A little cheesy, maybe, but as you can see from the definition here, it's designed to shift the company's entire focus toward that sustainable, organic growth we talked about. The key pillars are pretty clear: building stronger, more distinct brand identities, pushing harder on product innovation, and trying to create a deeper sense of loyalty with their customers. The ultimate goal here is to move beyond just being a mall jeweler that has to compete on price and promotions, and instead become a portfolio of desirable, coveted brands that can command a real emotional connection, and, more importantly for investors, higher profit margins. All right, let's just stop right there. shaping distinct and coveted brands, unlocking portfolio value, strengthening our operating model. Lead analyst, this sounds like it was written by a committee of management consultants in a windowless conference room. It is filled to the brim with the kind of corporate jargon that can mean absolutely everything and nothing at the exact same time. Is there any real substance here? Is there a concrete, actionable plan with deadlines and metrics behind these buzzwords? Or is this just a fancy new coat of paint on a very shaky structure? We need to see the actual work orders, not just the glossy architectural rendering. And that is a completely fair challenge, and this next slide is where we get the answer. Because behind all that corporate speak, there are some very concrete actions. First, they are sharpening the specific roles for their big three brands, Kay, Zales, and Jared, to try and reduce the overlap where they're competing with themselves. Second, there's that James Allen sunset again, which is part of a broader plan to elevate Blue Nile into a more premium luxury position online. Third, and this is absolutely critical for any retailer today, they are actively optimizing their physical store footprint. In plain English, that means getting the heck out of dying, low-traffic shopping malls and investing real capital to modernize the stores that are in strong, profitable locations. And finally, it's all tied together with a renewed focus on improving the customer experience across both their physical stores and their online channels. So yes, there is a tangible plan here. The real question is whether it will actually be enough to fight the headwinds. Which brings us to our final analysis. Because even the best-laid blueprint, the most detailed strategy, can completely fail if the ground it's built on is unstable. We have looked at the solid past performance. We've seen the ambitious future plan. Now we have to turn our attention to the external pressures and the internal vulnerabilities that could crack this company's foundation, no matter how well they execute their new strategy. These are the dangerous fault lines that every single investor needs to be aware of before putting $1 into this stock. Let's start with a breakdown of what they actually sell. This chart shows it all. Signet is overwhelmingly, dangerously dependent on one single category, bridal jewelry. At 49%, nearly half of their entire business revolves around engagements, weddings, and anniversaries. This is a textbook example of massive concentration risk. The bridal market is notoriously sensitive to economic conditions. People put off expensive engagements during recessions, and it's also subject to shifting cultural trends. So any kind of slowdown in this one specific category doesn't just hurt a division, it threatens the very core of the entire company. And that 27% share for lab-grown diamonds, that's another huge bet on a very new category, where pricing and consumer perception are still evolving rapidly. Whoa. Okay, now this number right here, this is a massive red flag for me. 42% of their eligible North American sales are financed. That is not cash changing hands. That is credit cards, lease-to-own programs, and those buy now, pay later schemes like Affirm. This means a huge portion of their entire business model is propped up by the availability of easy credit. So what happens when interest rates really start to bite, when consumer debt becomes a problem, and people can no longer afford to finance a $5,000 diamond ring? That's a huge chunk of their revenue that could basically evaporate overnight. Their foundation isn't built on solid cash, it's built on a mountain of consumer debt. And finally, let's just look at what the company itself is worried about. This isn't our analysis, this is coming directly from the risk factors section of their legal SEC filings. This is them telling investors point blank about all the fault lines. First, they're extremely vulnerable to any decline in discretionary spending. Jewelry is a want, not a need, no surprise there. Second, volatility in the price of gold and diamonds can absolutely crush their profit margins. Third, the jewelry business is and always will be intensely competitive. Fourth, they specifically call out their heavy dependency on the holiday season, which puts enormous pressure on a single quarter of the year. Fifth, they explicitly mention the growing threat from organized retail crime, those smash and grab thefts you see on the news. And the last one on this list is the most telling of all. They list a failure to execute their own major strategic initiatives as a key risk. They know their plan is complex, and they know it could fail. So, after all that, what is the final verdict from Iron Financial? Well, the bulls out there are going to point to the solid track record, the strong brands, and that consistently growing dividend. They'll argue that this is a company that knows how to operate and will figure it out. The bears, however, see a company that is openly warning everyone about a coming slowdown, is heavily reliant on a financially stressed consumer, and is facing a mountain of external and internal risks. Our take? The market's negative reaction was completely justified. The weak guidance is a major, major concern, and until we see clear, undeniable proof that their grow brand love strategy is translating into real, sustainable top and bottom line growth, we would be extremely cautious here. This might be a diamond, but it is still buried deep in the rough, and there's a whole lot of heavy, risky digging left to do.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.